Imagine the Reserve Bank of Australia's top decision-makers grappling with a high-stakes choice: slash interest rates to fire up job creation, or hold steady to keep inflation in check. It's a classic economic tug-of-war that could shape Australia's financial future, and it has economists buzzing with anticipation. But here's where it gets controversial: should boosting employment take precedence over fighting rising prices, especially when data seems to contradict itself? Let's break this down for newcomers to the world of finance. The Reserve Bank of Australia, RBA, is the nation's central bank, responsible for managing monetary policy. Think of it as the steering wheel for the economy, using tools like interest rates to influence how money flows through businesses and households. Lowering rates makes borrowing cheaper, encouraging companies to invest and create jobs, while also prompting people to spend more. On the flip side, keeping rates higher helps cool down inflation, that pesky rise in prices that erodes your buying power, by making borrowing more expensive and slowing economic activity. It's a delicate balance, and getting it wrong can lead to either stagnant job markets or runaway costs at the grocery store. According to RBA Governor Michele Bullock, who shared her insights during a cozy fireside chat at an economists' forum in Sydney on Monday, the board faces this exact dilemma. She's not rushing into action, though. Pointing out that monthly economic data can be wildly unpredictable, much like flipping a coin that sometimes lands on heads and sometimes tails, Bullock emphasized the need to gather more information before making a move. She's referring to recent surprises, such as unemployment figures that climbed higher than expected and inflation readings that also ticked up unexpectedly. In her words, monthly data can be volatile. We just have to wait for a bit more data. And this is the part most people miss: in a world where instant decisions often rule, Bullock's patience might be the key to avoiding costly mistakes. But let's stir the pot a bit. Critics might argue that prioritizing jobs through rate cuts could ignite inflation, leading to a cycle where prices soar and erode wages, potentially hurting the very workers the RBA aims to help. Others contend that in a sluggish economy, fighting inflation too aggressively might crush job growth, leaving millions underemployed. Is the RBA playing it too safe by waiting, or is this caution the smart path forward? What do you think? Should economic leaders lean towards stimulating jobs even if it means flirting with higher inflation, or vice versa? Drop your thoughts in the comments below. I'd love to hear your take on this heated debate.